Alright, guys, so the Chinese dump of US bonds is not over yet. And as we mentioned before, China sees no real incentive to keep holding US debt. Honestly, just ask yourself this. Would you willingly help the economy of your biggest rival, a country that is actively trying to contain you, sanction you, and outcompete you on every strategic front? Chances are you wouldn't. Because buying US Treasuries today means financing your own economic pressure. It means funding policies designed to weaken your position long term. And from Beijing's point of view, that makes absolutely no sense. And in this confrontation, China has many levers it can pull to derail the US economy. Rare earths are one of the most powerful examples. Now, the rare earth squeeze is quietly coming back. In November, China's rare earth magnet exports to the US fell by 11%. Beijing exported 580 tons, down from 650 tons in October. That is not random. That is not a supply glitch. That is a signal. The US wants China to sell more, badly. US companies, from chip makers to automakers to defense contractors, all rely on these materials. China understands this leverage very well. And China also understands something else. The US is actively working behind the scenes to break away from Chinese dominance. Behind the handshakes, behind the official statements about cooperation, lines are being drawn. The US is trying to compress 20 years of neglect into a 4-year window. And the last thing China wants is to fund that breakaway. If you buy US Treasuries today, you are directly helping finance the policies of Donald Trump. Policies that are openly hostile to China's long-term interests. Now, take the US response as an example. Washington has suddenly rolled out initiatives aimed at countering China's dominance in critical minerals. This isn't strength, it's desperation. The US has finally woken up to the importance of energy security, critical minerals, and domestic manufacturing. But the reality is harsh. They don't have the infrastructure, they don't have the mines, they don't have the refining capacity. So now there's a frantic scramble to rebuild the entire system, especially looking ahead to 2026, and the hurdles are enormous. Rebuilding supply chains, opening new mines, constructing refining facilities, this all costs an extraordinary amount of money, and the only way to attempt it is to borrow. But that's where the real problem begins. The US government is running out of fiscal space? The bond market itself has been in revolt for months. Since September, the Federal Reserve has cut rates 3 times, 75 basis points in total. Normally, that should push borrowing costs down, but it didn't. The US 10-year yield is still well above 4.1%. Even more concerning, after the most recent cut, yields actually moved higher. That's not a technical issue, that's a confidence issue. Investors are beginning to realize 2 things at the same time. First, the AI and technology race with China is going to be extremely expensive. Second, rebuilding domestic industry will require massive debt issuance, and over time, the dollar itself will have to weaken to absorb that debt. US officials simply can't stop borrowing. And now, China is throwing more spanners into the system. Beijing is reducing its treasury holdings for 2 very clear reasons. The first is obvious, de-dollarization becoming more sanction-proof. The second is a natural byproduct of the first, raising US borrowing costs to make competition more expensive. China has officially cut its treasury holdings to $688 billion, the lowest level since 2008. That's a $12 billion reduction, and the direction matters more than the number. The unwind is here, and it's not stopping. Either China is actively dumping its holdings, or it's letting bonds mature without reinvesting. Either way, demand is disappearing. Once upon a time, China held over $1.03 trillion in US debt. Today, that figure is nearly 50% lower. We are back to 2008 levels, a period many people forget. Back then, Beijing stepped in and bought large amounts of US debt to stabilize the bond market after the housing collapse. That intervention mattered. Without it, yields would have exploded and the recovery would have taken far longer. China did the US a major favor during one of its most vulnerable moments. Fast forward to today, and Chinese frustration is easy to understand. After sanctions, asset freezes, trade wars, and technology bans, Beijing learned a crucial lesson. Foreign reserves can be weaponized. And buying US Treasuries today would mean helping finance policies that openly target China's economy. That is simply not going to happen. Meanwhile, the US economy is caught between a rock and a hard place. The tariff war is starting to backfire. Borrowing to boost consumption is no longer viable. So policymakers are now recycling tariff income back into the economy through refunds and incentives. But think about how strange that is. That money came from US consumers in the first place through higher prices. Recycling it back is a quiet admission that the tariff war is hurting households and compressing living standards. At the same time, interest payments on US debt have reached $1. $24 trillion per year. Over 4% of GDP, just a service interest. If nothing changes, that figure could rise to 5 or even 6% of GDP in the coming years. At that point, debt becomes self-reinforcing. Foreign investors see this clearly. That's why foreign ownership of US debt has fallen from 51% in 2008 to 32% today. Domestic institutions are now carrying the burden. Outside the G7, many countries are quietly shifting capital elsewhere, into gold, equities, and increasingly, Chinese bonds. China is doing the opposite of the US. Beijing is supporting currency stability. It is attracting capital, and it is benefiting directly from de-dollarization. Every time the dollar weakens, China gains, funding costs fall, demand rises, and capital flows follow stability. The endgame is not complicated. Either rates come down or spending comes down, and politically, spending cuts are off the table. The trade war is set to continue. China understands this. That's why it's reducing exposure now, before the stress peaks. So the real question isn't whether China will keep reducing its US bond holdings. The real question is who follows next, because once confidence breaks in the bond market, it doesn't come back quietly. Let me know what you think. Will China keep dumping US bonds? And is there any realistic way out for the current US strategy? Stay safe, and we'll keep breaking this down as this story continues.